Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for, and what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. I want to thank everybody for listening to us. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC registered investment advisory firm. We want listeners who are interested in raising their financial IQ. That's at the heart of everything we do as education on this radio show. We're not here to pitch you annuities, lifetime income this, lifetime income that, guaranteed this, guaranteed that. We're here for education. And so if you listen to the radio, you know most radio shows are an annuity pitch wrapped up as financial planning. That's not what this show is. And if you've listened to me in the past, you know that. So we're going to talk an awful lot about that this week. As I mentioned, my name is Robert Kuhn, and we are an SEC registered investment advisory firm. We're headquartered in Oak Brook. If you Google Fidelity, Oak Brook on 22nd Street. We are in the same building. We're on the 5th floor, Suite 530. Stop in and see us. We would love to talk. You just may have to wait a bit, maybe on a conference call or meetings, but that's okay. So come on in, 630-492-1912. If you'd like to schedule an appointment, 630-492-1912. Banknotes are proving their worth. As you know, we do a lot of banknotes. The banknotes are backed by the largest banks in the world, JP Morgan, Citigroup, Bank of America, Morgan Stanley, BMO, BNP, the banks, Goldman, all of the big banks. And they're currently still pricing in the 13 to 14% range annually. You receive those distributions, dividends, coupon payments, interest payments, call them what you want. Monthly, so it's an annualized number, so 13 to 14% annualized and paid monthly. So March, the market was down 7%, 7.5%, and the banknotes still paid their coupon payment. So think about that. Market's down big, but you're still clipping the coupon payments. As long as those indexes that the notes track are not down 30%, you're making your monthly coupon. So we're going to lean into that. We're going to continue to push those stories because I can't tell you how many investors I meet with that are interested in strategies like that. Excuse me. The other options for, quote unquote, safe money are bonds, and just take a look at bond rates, bond yields, look at a 10-year bond fund, bond ETF, and you're going to be grossly disappointed of the returns. And so when you look at what most individuals, advisors at least, on the radio, of course, and even TV, they are pitching the lifetime income story, and the lifetime income story sounds absolutely phenomenal. Who wouldn't want to hear lifetime income? But you have to look at what are the drawbacks to that. Number one, generally they're going to tell you to wait 5 to 7 to 10 years. They're going to show you an illustration of hypothetical performance. When you compare those exact same investments with real performance, those same strategies, real performance over the last handful of years, it is going to look generally dramatically different. And they're going to put a governor on how much you can withdraw. And so when you look at that and you look at all of those strategies, it's a massive market. But I don't think advisors are doing their really fiduciary duty of explaining what they are and what they're not. You are only taking your own money out until you get to zero. When the account goes to zero, you are actually then into the insurance company's pockets. You have to ask yourself how many insurance companies actuarially are going to let that happen. So if you wait 5, 7, 10 years and you get very, very limited growth, they all show these splashy bonuses, 14% bonus, 20% bonus, 50% bonus. It's to the income number. And when you have a bonus, the growth is metered even more. So these are just basic things. So if you look at comparing the banknotes versus the insurance products, the lifetime income products. If you're looking for cash flow, they can't compete. And if you're sitting there waiting for 10 years and getting subpar growth, and then going to be metered on how much income you can take out, where you consider the banknotes, we are actually making double digits as long as those indexes don't go down 30%, and as long as they're still pricing at that price, of course. There's very little comparison. The only main difference is those annuities, they say you don't pay. The insurance company pays. Well, okay, fine, but somehow you're paying, right? Those pay a big commission, 7, 8, 9, 10%. I mean, crazy commission. The banknotes, unfortunately, we make our measly, 1% a year. So any way you look at it, if you do a side-by-side comparison, I think you're going to find, which one is more appealing. But again, our job isn't to tell you which. Our job is to educate on both and then let you decide. And that is why I think we capture the interest of a firm that we do. Sure, the banknotes, anytime you can say 12, 13% backed by the largest banks with 30% downside before you don't get your monthly coupon, that's going to appeal to a lot of people. It is an investment product, so it does come with a prospectus. It's always best practice to read the prospectus. That is something that I encourage everybody to do. Put it in ChatGPT, do whatever you need to do. Let it give you a bunch of questions. Again, education. And those are the things that we're here to help you with. So if you own an annuity and you were sold one on an illustration that showed ridiculous performance, and your performance over the first 2 to 3 to 4 years has been not anything close to what you were shown, which you're not alone, let us do the math and see if we can help you get out of that, even with the surrender charge. So we can certainly do some math. So 630-492-1912, 630-492-1912. Obviously, what's going on overseas, the markets have been hit. The markets continue to get hit. It's anybody's guess as far as what is going to happen in the market. Markets ultimately always go up. There is absolutely no doubt about that. I continuously hear from potential investors that their advisor is telling them just sit and wait. They're good names. It's ultimately going to come back. A very accurate statement. I mean, 100% accurate statement in time. And what length of time are we talking about? You bought Microsoft in 2000. It took you 14 years just to get back to even. 14 years to get back to even. I don't know if we're in that market. You don't know if we're in that market. Maybe the markets just continue to go up 20 to 30 to 40% a year. Most professionals believe that based upon the current valuations, albeit they've come down somewhat, that we're already looking at low growth in the market, and people have the bulk of their money tied to equities and fixed income. So you may be very, very well diversified in the equity space. You may own 50 stocks, 100 stocks, 200 stocks. You may own 10 mutual funds, 10 ETFs, and you think, my goodness, I'm diversified. Well, you are, but they're all equities. And as you know, rising tide lifts all boats, and a lowering tide brings all boats down. So you're diversified in one aspect, and then you may have some fixed income as a means of quote-unquote protection. That is not diversification. That's not how we look at it. So when you look at what we're doing, again, we have the energy strategy. I heard somebody on another radio show said that energy investing is a scam, and I could not agree more with 99% of energy funds that are out there. Could not agree more. I see more and more and more social media funds in the energy space that are off the beaten path, owner-operated drilling, small mom-and-pop type stuff, and that is why we created Bison, the Bison Fund family. And so when we are talking about our energy strategies, massive diversification. We're not doing the drilling. Massive diversification in the tier 1 acreage of the best oil field in the world, the Permian Basin. So currently we have 49 producing wells, 7 to 8 different operators, albeit in the Permian. We ran economics at $55 oil, and it produced what we thought. It would produce an 18% cash flow this year, gross cash flow. Again, when you have tier one acreage with the Exxon, Chevrons, Conocos, Matadors, Mewborns of the world, these are the biggest and these are the best operators. This is the best acreage. When you're in the Permian, when you're in tier one of the Permian, Reeves County, Lee County, and you're in the right counties, they're just too cost prohibitive for the small drillers. And so when you have a fund like ours that takes minority interest, 1%, 3%, 5% in the majors projects, and you commingle them all together, maximum diversification of operator and geographically, albeit being in the tier one acreage of the Permian. And at $55 oil, our pro forma ran out at 18% cash flow this year. Now, I don't know if that'll happen. I mean, oil is obviously much, much higher. So in theory, you would think the distributions are going to be much, much higher. But here's the great thing about a fund. We have now tremendous interest of people that want to get into the fund because of the assets that the fund already owns. And when you own a fund, if you're a new investor, you get a benefit from those assets. So we are looking to close the fund out end of third quarter this year. So if you're a high wage earner, sold a business, sold a building, want to reduce your active or passive income, again, we target 80% tax benefit for every $100,000 invested. So if you put in $100,000, we target $80,000 to reduce your active or passive income. That's incredibly significant. Again, we're not tax professionals. This is for informational purposes only. We always encourage you to talk with your tax professional, bring in your tax professional in the conversation. We're completely okay with that, albeit these are very black and white. Those are just the qualifications that we have to share when we're talking about these strategies. And again, with anything, past performance is not indicative of future results. So we think, though, with oil prices being where they're at, there's a significant built-in margin of safety. So, per one of the other individuals on the radio said oil and gas is a scam. I agree 99%. And I don't want to say a scam, okay, because that's assuming a person is bad. I just want to say that they're not as they generally won't work out as marketed. Let's just say that. But when we have ours, I promise you, I challenge you to go and find a fund that acquires the amount of acreage that we acquire with these operators in these geographic locations with a 5-year targeted exit with significant tax benefits and, targeting 15 to 20% cash flow at $60 oil. Again, that can change, of course. If oil's higher or lower, that can change. There is a variable there, but I really challenge you to try to find that. So if you want to learn more about that, again, it's a private placement memorandum. It's like the quote-unquote prospectus. These are things that you have to read. We'll walk through line by line with you. So after we get back from the break, we're going to talk about Bison Alpha and a trade that we made this week and talk about flexibility. So 630-492-1912, 630-492-1912.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at KuhnCP.com.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary, SEC registered fiduciary, headquartered in Oak Brook. So we look at the mall. We look right at the mall. If you want to know where our office is, just Google Fidelity in Oak Brook. We are in the same building. We are on floor 5, suite 530. So we'd love to have you stop in or call and schedule an appointment. And again, everything we do is education, whether it's financial planning, tax reduction, maximizing growth, reducing risk. There's a strategy for that. And the strategies are generally the strategies that we use. We know they're not cookie cutter. As you know, we talk a lot about the banknotes. Banknotes are still pricing phenomenally. Backed by the banks, JP Morgan, Citibank, America, Morgan Stanley, UBS, BMO, BNP, all the biggest and best financial banks in the world. And those are still paying very strong. 12 to 14% is where they're currently pricing. Now, that is an annual performance. And you get that paid broken down into monthly payments. And it's so simplistic from the date the note prices. As long as those indexes are not down to 30% or more on that monthly valuation, you get paid your coupon payment. So yes, even in March when the S&P was down 7.5, all of our notes, not our notes, but all of the notes that we own for clients still paid. And that's a huge, huge win. And so those are the strategies that we love to talk about. So past performance is not indicative of future results. Obviously, these are a prospectus item. It's always best practice to read the prospectus. We can go through it line by line, but it is rather simplistic. But if we can help you out in any way, just let us know. 630-492-1912, 630-492-1912. So one of the benefits of being independent, being a SEC registered fiduciary, is we have 2 private funds that are ours. And some people will say, well, that's a conflict of interest. Well, okay, yes, they are. That is a conflict of interest. They are our funds. And the way that we try to reduce that conflict of interest is always doing what is in the best interest of the clients. The 2 funds that we have, one is in the energy space, significant tax benefits, albeit we can't provide tax advice. So best practice is always reach out to your tax professional, bring them in on the conversation. But if you're sitting on significant capital gains, if you have sold a property and you have gains, if you are a high wage earner, if you sold a business, and you're looking to defer those gains, we need to have a conversation. So we always target $80,000 of active or passive tax reduction per $100,000 invested. Could be more, could be less. Generally, it has been more. But again, we want to go in being very clear that this is our target. We never want to buy something just simply based upon tax benefits. But when you can look at a client, you can say, here's a strategy that can greatly, greatly reduce your taxable income, greatly, greatly reduce your taxable income. Sold a business. We're talking with individuals, a lot of dentists that are selling their practices, and just a lot of people in that $1 to $10 million kind of annual revenue number that they're selling and walking away with, 2 to 10, 2 to 15, 2 to 20 million. We have to look at how can we reduce some of those taxable those taxes, and the energy space really does that. And so, love to have a conversation about Bison 2, what it is, what it's not. Get you the regulatory documents so you can make sure that you could read those, watch the educational videos that we've put together, and let's have a conversation. Currently, since the fund is almost 15 months since we've opened it. All of the assets currently, which are significant, got a lot of great operators, Exxon, Pioneer, Mewbourne, just a lot of the big operators. They were purchased at much lower oil prices, and that is a benefit. So if you do come in now, you get a benefit from those assets that were purchased at much, much lower oil prices. But we are cash flowing. So we cash flowed in year 1, which generally we don't really want to, because when you acquire these assets, it takes some time, 30 to 60 to 90 days, just for the operator to know and the state to know who owns it. And then, you start to get your distributions. But last year's wasn't too bad. I mean, it was only 4%, but, again, close to it. Little. I think it was a little more, but I don't have the exact number. But in year one, you're really loading the fund, and you get the big tax benefits in year one. But those individuals that are coming on now, distributions for this year, we think are going to be significant. So if you're looking for a strategy that can reduce taxes and also provide strong targeted distributions on a quarterly basis, give us a call. That's Bison 2-630-492-1912, 630-492-1912. We'll set up that call. Also, Bison Alpha, that is a hedge fund that we run, so proprietary to us. It's kind of how we manage and think about, how we manage our own money, and we wanted to do it at scale. So we created a fund, maximum flexibility. Most people don't know this, but when you have a mutual fund or an ETF, they have to stay fully invested no matter what. So they could have tomorrow's newspaper and they could see the markets are going to drop 25, 30, 40, 50%. 99% of mutual funds have to stay fully invested. This fund can go 100% cash. This fund can go 100% for the market. This fund can use leverage. This fund can go in any asset class. And past performance is always not indicative of future results. That is a must. You must understand that. And so when we talk about performance, we talk about strategies that we've used. This is really for educational purposes only, because we want you to know that, you can't, just because of what we did doesn't mean you could expect those performance, those returns going forward. Now, obviously, we want to replicate that, right? But when you look at having flexibility, obviously in the oil space currently, oil's been going to the moon. It's been a very relatively straightforward trade to buy options on oil. And our last purchase, we made almost 100% on the on that trade. Now, again, that's one trade. Do not ever, ever, ever invest with us because of one trade. I mean, we're telling you the good trades, right? We're still down like everybody else, but what we are able to do is to limit that loss by having the flexibility to really, utilize options in, asset classes that are, I don't want to say predictable, because nothing is predictable today, but there is some look through in the oil space. And so when you have a fund like ours, we can really provide maximum flexibility. And that's what it is. So you have to have $2.1 million net worth, not including your primary residence, or have $1 million with us. And if you have $1 million with us, then you fit the SEC's criteria of who can invest in those strategies. So again, past performance not indicative of future results. Don't invest with us just because of one trade that I told you. It's just really trying to display kind of the flexibility that we have, and trying to limit the losses inside of the portfolio when everything in the world is going down. And some people use us as a satellite manager. Some people utilize us to manage 100% of their money. And again, it's not what is our agenda, it's what's your agenda. So if you want us to manage just a piece, fine. If you want us to manage the whole thing, great. It's totally up to you. So the hedge fund has an offering document. So clearly, before you ever would consider investing, make sure you take a look at that offering document, and make sure you're comfortable with the risks and the possible rewards of the strategy. But in this type of a market, you have to have, in our opinion, maximum flexibility. And so when we look at what we do, of course, it's financial planning based. When we run as thorough, as detailed of a financial plan as you're ever going to find. Not only that, we also include our tax software. Again, not tax professionals, can't provide tax advice, but this is cutting edge tax software for financial advisors, so we can get a look through of the whole picture. And these are things that just other advisors aren't doing. We met with a client this week, pretty significant client, and we're talking about doing Roth conversions for this year, rather large, multi $4, $5, $6, $7 million IRA. And his RMDs are going to be significant. And that's something that most advisors don't talk about. When you have an IRA that's, $1 million or $2 million plus, your RMDs are going to be massive. And so we have to look at and have that conversation with looking at doing Roth conversions. And most people who have those large IRAs are also high wage earners. So most advisors or tax professionals are going to say, well, don't do it. Well, okay, that may make some sense, but what if we could do that and then utilize the tax benefits from Bison II, the energy strategy, to offset that additional income from the conversion? Well, ding, 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 ding. That is something that we are talking about. And again, it's not something that's done all in 1 year, but what if we did it over 5 years? What if we did it over 10 years? And so those are the things that we are talking about with our clients, and when we have their reviews. And this one was only a couple $100,000 conversion, because that's just what the math said for this year. But we were able to utilize the energy strategy to greatly or eliminate that additional income tax due to the conversion. And so again, can't provide tax advice. I keep saying that. Bring your tax advisor in, and we would love to speak with them. And if you don't have a tax professional, we'll recommend some to you. So it's a strategy that we're very comfortable with, very comfortable with having conversations with. But in this market, having the ability to, in a hedge fund, to go anywhere, to go against the market, short the market, go cash in a second, literally a second, quickly. I guess I can't define, how quick is, but it's quick. It's almost the press of a button or a phone call, and the whole portfolio goes to cash. When you're running a portfolio like that, that is really gives the clients an advantage that just most people don't have. So if you want to learn more about that, we'd love to share with you kind of what we're doing. 630-492-1912, 630-492-1912. More after the break.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at kuhncp.com. Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We're in Oak Brook, headquartered in Oak Brook. We're in the Fidelity Building, 1415 West 22nd Street. We look at the mall. We do have a national client base. We were looking at that this week, 17 or 20 states as well. So we love that also, especially with technology and just being able to Zoom and have conference calls. So it's just, for those advisors that have adapted that, it has been just a godsend for us to be able to reach out to people and investors, not be determining their quality of financial advice based upon geographically where they live. So 630-492-1912. If you'd love to get on our calendar, we'd love to have the opportunity to share with you what we're doing. 630-492-1912. Banknotes still pricing very, very strong, 12 to 14%. JP Morgan, Citibank, America, Morgan Stanley. People love it. People love it. They love that cash flow. You can use it as a cash flow story. You can use it as a hedge to equity markets. So many ways you can do it. And when you compare, that to a 10-year AGG, which is the bond index, just look at those numbers and look at the returns over the last 10 years. You're probably going to be greatly underwhelmed. And when you look at the banknotes, we did a lot. I think over the last 13 months, we did 70 to 80 million in new issuance, plus or minus. Again, I don't have the numbers right in front of me. That's not why you invest, though. I mean, that's not why you invest. But I would consider ourselves to be an expert, and I would consider ourselves to do it at scale. And when you do it at scale and you do larger notes with more notional value, meaning more money being invested in them, you get a higher yield than an advisor who doesn't do many and they just might do one-off. And so when you can tell a client, this note priced at 13.1%, you're going to get paid 13.1% divided by 12, and that's your monthly coupon rate, your monthly interest rate. And as long as those indexes that note tracks are not down 30% on the monthly valuation date, doesn't matter what happens before, the day after, it doesn't matter. On that valuation date, as long as they're not down 30%, you get paid your coupon payment. So in March was S&P, I think, was down 7.5, somewhere in that neighborhood. All of the notes paid, and that's a beautiful thing. And that is a very, very strong story. And again, it's education. And most clients will say, why doesn't everybody do this? Well, it's advisors. It's a tremendous amount of work. When you do 70, 80 million, hopefully we'll do 100 million this year. One of my partners said we want to do 200 million this year. You think of the amount of notes that we have that come due because they are callable in 6 months. And so that's the beauty of it. You're not necessarily making a 10-year annuity type commitment, and you have to pay this massive surrender charge after you're underwhelmed with the performance of those index or the whatever the annuity sub accounts or the annuity accounts are, because they showed you great returns on back-tested hypothetical illustrations, which the advisor knew. The advisor knew that the chances of those numbers actually materializing were slim to none. So it's you do have a lot of liquidity in these. Well, they are liquid. You can sell them every day. And now if you sell them, you're going to get current market price. And so it could be up, could be down. So generally we want to hold these until they're called, but not callable for 6 months. So we know we're going to own it for 6 months. So if you're looking for an hedge to equities, if you're looking for to get out of a lifetime income annuity that you were sold, if you were looking to replace some bond funds because of the performance in the bond space has just been underwhelming, let's have a conversation. Again, they're a prospectus item, so I always say read the prospectus. You want to read it line by line, we'll read it line by line with you. If you want to skim it, skim it. But again, it's always best practice to do that. So 630-492-1912, 630-492-1912. The energy fund, obviously, that is my opinion, a no-brainer considering what's going on in Iran, where current oil prices are. Many people think as soon as it's done, oil prices are going to drop like a stone. They probably will drop significantly, but you'll probably see them creep back up because the infrastructure damage that was done is long-term. So it doesn't really matter, to us. I mean, we like oil between 60 and 80. I mean, that as long as it stays between 60 and 80, we think we can hit our target. So we target 80% tax benefit. So for every 100,000 invested, you get a $80,000 tax benefit that can reduce your active or passive income. Pretty big difference from real estate. A lot of docs. I talked with a doctor last week out of Tampa. He did some real estate last year for depreciation. It just didn't work out, and he's now switched over to the Bison 2 investment. So it's significant. When it's active or passive, W-2, 1099, it's meaningful. Again, not tax professionals. Always good to talk with your tax professional, but these are very straightforward. We'd love to have conversations with CPAs. We prefer it, actually. Just because, it gives us an introduction to them, and most CPAs are looking for ways to offset taxable income for their clients, especially with an institutional strategy like this. When you're in the Permian with these operators with the targeted 5-year exit, the bulk of our assets were purchased currently to date. Obviously, we're still buying more, but currently to date in the when oil was in the 50s, 55, 60 area, obviously in theory you would have significantly embedded risk protection just with oil prices being where they're at. But even if they came down, you have to think about diversification again. You have an asset in energy in a strategy like ours that is not tied to the S&P. So let's say the S&P just has a terrible year. Let's say it has a terrible 5 years. And you own an asset like in the energy space that, is energy and oil and gas, I think, as most people know, is not going anywhere. There's just massive opportunity to try to offset a bad equity market, right? I mean, markets always go up. I just get so aggravated and irritated by these advisors on the radio that try to sell fear and then sell you this lifetime income annuity. And I just want you to know, if you own an annuity, a lifetime income annuity, if you're being pitched a bonus, it's not free money. The investments, there's two types of investments. There's a participation or a cap for a bonus, and there's a participation in a cap if you don't do the bonus. If you do the bonus, people think it's free money, which, I mean, I guess it kind of is for income purposes, but you're limiting the growth. They govern the growth that you could get. And the way that these insurance companies win is they govern your withdrawals. And the only way that you win, well, two ways that you win. I do believe there is massive comfort in knowing you have lifetime income. You win in that regard. It does give you that peace of mind. Okay, let's just be honest about that. But that's a challenge. And the other way you win, I guess, if you call it winning, is your account goes to zero, and then you're in the insurance company's pockets. They are then paying you. So do you realize if you own a lifetime income annuity, you're only taking your money until the account goes to zero. Then the insurance companies start to pay. So actuarially, I'd love to know that number. How many of your policies go to zero? We have to find that number. And I'm going to venture to guess it's almost very, very little. And most people would never invest if they knew what that number was. But they do pay a big commission. And there's a lot of guys out there that are slick sales guys that can paint a really, really nasty equity picture in the market. And they don't tell you how inflation could destroy that payment. You're in a fixed payment. What's everybody's gripe about Social Security? It's the raises, right? Well, at least you get cost of living raises with Social Security most years. The annuities, you don't even get that. Now, they say if you hit certain high water marks, it can go up. Well, yeah, I've yet to see one happen like that, or at least on any consistent level. So most people are sitting in these annuities that were sold them, sitting in generally people who come to us 2 to 3 years, 2 to 4 years in. They told us based on this illustration that the returns were going to be X. They haven't been anywhere close to X. As a matter of fact, some are well, you can never lose money, but the returns in many instances have been zero. And they want out. But there's these surrender charges, right? And the surrender charges pay back the advisor because those commissions are 7 to 10%. And it pays back the cost to hedge those policies. And so the surrender charges can be pretty meaningful. So we have to do a mathematical equation. If you look at the bank notes, for example, and if they're paying 12, 13, 14%, what is the likelihood that we can recoup that surrender charge in a year or 16 months or whatever, however you want us to model it out? And then you're on to real gains. You're on to real cash flow. And those are things that we do a lot of. So we'd love to do it for you. It doesn't cost you anything. If you do it or if you don't do it, it's totally fine with us. Again, it's not it's never our agenda. It's just how can we help? So 630-492-1912, 630-492-1912. But more and more recently, and we know the people that sell them on the radio. I mean, not only here in Chicago, but in other markets. And we inevitably meet with many of their clients that show us, they put 80% of their personal net worth, investable assets in an annuity. Well, first of all, that is a problem. That is a massive problem. And another thing, I talked about it last week, and I think I ruffled some feathers, but I think it's a very fair question to ask an advisor if they're pitching a single strategy. And I would ask the advisor, what percentage of your firm's revenue is made up of these strategies? That's a very honest question to figure out quickly the objectivity of the advice that advisor is giving you. Ask us. And I think you should ask every advisor that if they're selling and pitching one strategy or two strategies. It's a very fair question to ask. And you have to question the objectivity. Is it the 7 to 10% commission that they're getting? But, they don't pay you, right? You don't pay them, rather, the insurance company pays them. Well, if you're taking 7 to 10% off the top, they're probably limiting the growth, because if you look at the annuities that pay less, generally the growth is going to be more. So we can debate that, and we'll talk about one annuity we like after the break. 630-492-1912, 630-492-1912. More after the break.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at KuhnCP.com.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered fiduciary, SEC registered fiduciary. Our main custodian is Charles Schwab. So many questions and many clients have, our investors have questions how we work. You open accounts at Charles Schwab. We simply manage the money. We've gone through their due diligence, through their criteria that they are our custodian. They're our main custodian. And but I do, again, I want to reference it that they're not saying we're good or bad. So don't let the name Charles Schwab influence you at all, because there's just some big custodians out there, but we do use one of the bigger ones. So you set with us, you open accounts at Schwab, and we're simply the money managers on the account. So if you want to learn about the banknotes, everything is done through Schwab. So if you want to learn about our next banknote, maybe it prices 13%, maybe it prices 14%. Who knows what it's going to price? It might be JP Morgan, it might be Citigroup, Bank of America, Goldman Sachs. Who knows which bank it's going to be? But if you want to get on that list, certainly make sure that we know that. And again, you get those interest payments as long as the indexes are not down 30%. So in March, S&P was down 7.5%. Those notes still paid. Pretty nice to be able to make money when the markets were down. So now the downside to that is, let me tell you the downside. The downside is you do get a daily pricing on your statement. So when you see a note, the note you put in 100,000, you're going to see it deviate from 100,000. It may go up to 105. It may go down to 80,000. Who knows? It just depends, because you have to get a daily price of what, if you wanted to sell, they provide a daily price. Now, two things. You always get your interest payments on the original investment. And if and when it is called, it's always called for the original investment. So if you're not selling, I don't know, you just have to put that in context. And it's nice to be able to still have positive cash flow when the markets are down, like in March. So 630-492-1912, 630-492-1912. When we look at the war and we look at kind of the markets, beginning of this year, markets on a PE valuation were very, very extended. And I think it was over 24, 25 at one point. And when you look at the 10-year forward number of returns during that 10-year period, generally they've been between -2 and +2. That's not my opinion. Those are just the numbers. So when we look at the market, we think those that are expecting or needing significant growth to meet their plans are going to be disappointed. And you're going to be disappointed if you're working with an advisor that simply has you fill out a risk tolerance questionnaire and then puts you in a model balanced X portfolio. I believe, I don't know if it was all of March or if it was just last week. So I have to take that next statistic with that kind of qualifier. But the 60-40 portfolio had, I believe, its worst period in a long time. I don't want to say history because, again, I heard the statistic on CNBC pretty quickly. But again, 60-40, 70-30, if that's how you want your money managed, I strongly, strongly encourage you to do that on your own. Go to Fidelity, go to Schwab, meet with advisors on a quarterly basis. If you just want set it and forget it, and you don't want to have cutting edge risk management strategies, you don't want to have strategies like the bank notes that can still pay out each month as long as the indexes are not down 30% and they're backed by the largest banks, or the Bison II strategy or energy strategy that provides significant tax benefits along with strong targeted cash flow. Again, the best thing right now, what we're seeing with the Bison II strategy is that we already had significant assets in the fund at much lower oil prices. Now, of course, it's tragic what's going on. Very, very tragic. And, if we look at it, it was purely dumb luck that, we acquired these assets at much lower oil prices. And then we get into this war and oil prices are what they are. But again, in theory, if we thought the prices were, or the strategy was good at $60, $55 oil, well, you can think, it doesn't take you don't have to get too creative to think that there's a lot of built-in safety now with oil prices being where they're at currently. And so that's a benefit of a fund. We're not going to tell you, here's what we're going to do. That's what we told investors for the last, when they started, when we didn't have any assets in the fund. They just went off of our historical performance and other funds and reputation and et cetera, et cetera. And everything we do, again, with the funds, both Bison II and the hedge fund, Bison Alpha, they're all third-party administered. So there's a third-party custodian, third-party fund administrator, third-party transfer agent, third-party accounting. Every one of the funds are audited on an annual basis. That's criteria to remain in good standing on the Charles Schwab custodial platform, which I think is good business anyways. So we believe in maximum transparency. And so most of these funds, especially in the oil space, unless you want to invest several million, you're just not getting that. We see so many marketed deals on Facebook. I just can't believe it. I can't believe what people are marketing on Facebook. And when we look at, the owner-operated stuff, off the beaten path stuff, if the people who are raising the capital are also doing the drilling, generally speaking, you don't want to invest. It's just kind of a rule of thumb that at least is my rule of thumb, because if you can't get 5 to 10 million and you've been in for any length of time in the energy space, there's a reason you're using other people's money. So tax benefits are strong. Compliance and transparency is as buttoned up and as transparent as you're going to find. Phenomenal data room, videos. Again, the premise of our firm is education. We want to educate investors. We want to raise the financial IQ. You don't need to be experts. You don't need to understand. I want you to understand it, but that, we just want to educate you. We want to educate you on what things are and what things aren't. The bank notes. After we give our education on the bank notes, generally speaking, we're going to hear, why doesn't every advisor do this? Why doesn't everybody invest in it? Well, it's a lot of work. And you heard the old adage, can't teach an old dog new tricks. Most advisors that have tenure in the industry, they're making good money. Most probably 7 figures. And they're not going to upset the apple cart. All right. That's just the way it is. And unfortunately, most advisors don't even know about them. I just happen to be, I love these strategies in the early 2000s. These are not new. They're not cutting edge in any way, shape, or form. They're private bank type strategies. So you do see them in the private bank significantly. And we've had a lot of people that, we do a lot of Chase bank notes, and I think Chase calls them enhanced income yield notes. We just call them bank notes for simplicity. But where listeners will go into the bank advisor and say, hey, why can't we do this? And the advisor doesn't even know about it. It's a darn bank that's issuing it. So, that's, our job. Our job is education. I think people resonate to our firm for that purpose. The financial planning is second to none in our opinion. The tax strategies that we use are absolutely second to none, albeit we're not tax professionals. I can't provide tax advice, but when you look at energy strategies, the tax benefits are significant. And we love talking with tax professionals. Love it. I think it just gives you that extra piece of comfort, and we have no problems doing that. But that's what we do, and we're going to keep doing it. We're going to keep leaning into what we think is going to give investors the best chance to succeed, the best chance to you have to get value for what you're paying for. And my belief is, unfortunately, most advisory firms, my buddies included, it's just a closet index fund. It's wrapped up as something proprietary. We win as you win, blah, blah, blah. But it's just the market. Market goes up, market goes down, the markets go down. It's sit and wait. You're going to be perfectly fine. That's an accurate statement. But what if you had to wait 14 years? And you do realize that every loss requires more gains before you actually start compounding your money. So as the great Charlie Munger said, don't interrupt compounding unnecessarily. And that's something that we try to adhere to at our firm. So we'd love to meet with you this week, whether it's a conference call, whether it's a Zoom. If you'd love to come into the office, we would love to welcome you into the office this week, next week, whatever time works for you. Just get on the calendar, 630-492-1912, 630-492-1912. More next week.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at KuhnCP.com. This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.